Hi everyone, it's Mike from Order Flows and welcome to the Advanced Order Flow Trading course. This is Module 2, Finding the Order Flow Honey Hole. Now, if you're not familiar with the term honey hole, it's a term used by hunters and fishermen to describe a location that they have a good chance of finding a fish or animal that they can catch and eat. It is their go-to place when they need results. In trading terms, in terms of the market, it would be a location where a trader has potential for catching a nice big move. So, before we begin, go through the disclaimer, don't trade with money you can't afford to lose, and trading is risky. So, on the History Channel on cable TV, there's a show. It's called Swamp People. You could actually probably find it on YouTube. And what it is, it's a group of people that live in southern parts of the United States, and they hunt alligators for a living. Basically, if they don't catch, they don't eat. And how do they catch them? Well, they hunt for the alligators in areas where they're most likely to be, their own honey holes, around the riverbank, in a mess of trees at the edge of the water. Each hunter has their own way of catching the alligators. They got their own special bait. If you're a trader, think of it in trading terms, right? If you're a fisherman or a hunter, right, you have your own special bait, you have your own special location that you want to go try and catch fish or hunt for animals. And in trading, right, you have your trade setups, that's your bait, and your market structure is your honey hole, depending on where the market is. You got to look for trades where they're most likely to occur, where traders are being sucked into the market, so you can find where traders are being trapped, around the swing highs or swing lows, in a trend, etc. You, a trader, have to have your own honey holes, areas where you're looking for trades that are going to give you good results. And, if you've been following, my order flows training for many years, I've always talk about, my favorite trade setup. People always ask me, what's your favorite trade setup? It's my ratio and divergence trade. And it's a trade that happens at a high or a low. And basically, a ratio is my own form of analysis in the order flow. And, each bar will have a ratio. It's either going to be above it for a down candle or below it for a green candle. But if it's a blue number, that's telling me, there's something interesting in that order flow. It's telling me there's either price rejection or price defense. And I find that when they're at highs or lows of the day, coupled with a divergence, meaning you're at your high of the day, you've got negative delta, or if you're at your low of the day, you've got positive delta, it's giving me a high percentage trade. Now you can see here, this is in crude oil from back in November. At the high of the day, there's a nice ratio and divergence. The market sold off earlier, probably about 15 minutes prior to that. You also, as you're making new highs, you also had a ratio and divergence. Well, this one, the market just went sideways. And, I could have put this chart up here where I cut this trade off, so you just see this nice winner. But, with trading, just like in hunting, you put out the bait. Sometimes you don't catch anything. And then finally, you catch something which makes up for the loss. So like this first trade, I would take it, and it just ends up going sideways on me. Okay, I could read the order flow. I know I could cut it for a small loss. Then I just wait for the next trade, right? You don't catch something the first time, you wait for the next trade. Then, you catch enough to make up for what you lost on the first trade, as well as put you in the profit. At the low of the day, ratio and divergence, right? We got the bullish ratio, and indicating to me that there's stopping power, price support in this case at the bottom of this move, and I've got positive delta, so I got my ratio and divergence, and you see the market made a nice move up in the S&Ps. This is a 5-minute chart. You're looking at about a 10-point move on a 5-minute chart. But I know my honey hole, so to speak, is the highs or the lows of the day. I don't get many trades. It's not designed to give you tons and tons of trades a day, but you should have basically in your back pocket is a term we used to use, trades that, when they appear, you take them, period, without question. Now, that leads into the next part, right? The single most important skill that a trader can develop basically is the ability to determine when a breakout will continue or fail. Okay, and why is that important? It's because if a breakout continues, you can experience the beginning of a trend. Now, if a breakout fails, you can be looking at a potential market reversal. And that's important because, when you're at highs or lows of the day, you should be asking, are we going to break out to new highs, or are we going to put in a reversal? And if we're at the high of the day and we put in a reversal, what's the profit potential? Well, immediately, you're thinking half back from the whole move, and ideally, you're looking, your target can be the low of the day and probably lower. So this is going to give you an edge over other traders, once you understand the immediate direction over at least the next few bars at a minimum. We all like the moves that go from the high of the day to the low of the day and lower, but realistically, you got to be focusing on what's happening right now once you get into the trade. If you have a view like here, right? I have a view that this market's going to rally up off this bullish ratio and divergence. And I'm monitoring what's happening in the order flow over the next few bars, right? If it starts looking bearish, you get out. But if it's still bullish, you stay in to catch the move back up, right? Here you can see how this market moved basically back up to where we were right before the big move down. Now, here is a 1-minute chart on the E-minis, and this is where you got to put the different pieces of order flow together and use what you know about the market into your analysis. And I know that, okay, this green line is the high of the day. This yellow line is the opening price of the day. And in between, I have this 6-bar period where the point of controls are all at the same level, 31.17.5. All right, and it's coming into an area where I know I have resistance already because it's the high of the day. Also, an area of resistance, depending on where you're trading, could be resistance or support at the opening price. I talk about that a bit later, how the opening price, acts as a focal point for a lot of traders. So, we're trading below both the high, and the opening. We rally back up, then we get up sort of into this DMZ, the no man's land in here, and we put in 6 bars with points of control at the exact same level. Market starts coming off. So I know basically between 16.5 and 18.5, I've got strong resistance, and it's just highlighted here with these 6 bars, the 6 points of controls all lined up at the same level. And then notice the delta also, even though you're getting these push higher, here you got a bar with very strong delta, 734, then the next bar, 98, 64, negatives, 77, -7. This is an area where as we're coming up in here, buyers are aggressively pushing the market up. You can see a nice positive delta, 193, 162, 700, but then just 98, 64, 77, 7. Okay, well, even though there's aggressive buyers, in these bars, it's met with passive sellers. And then finally, the aggressive buying is done, right? They can't get it any higher. And then you start seeing the deltas. Look at this. It goes from -7 to -600, -752, -1,000 in an area that is resistance. Market sells off. You get that rally back up in here. Boom, you get a nice bearish prominent point of control right here, right when you trade right at the opening price, 31.16.5. So I know I got some strong resistance up here, right? The market is rallying back up into the high of the day. So I got to determine, are we going to keep going up, take out these highs, or are we going to come off? We start coming off. I mean, I could have got short, just by watching how this delta is reacting, how the aggressive sellers are coming in here. But if I'm like, I'm not convinced that this is resistance, then when we sell off and make that rally back up in here, I know now I'm convinced that we do have resistance up here. I got this bearish prominent point of control right as we're coming ahead of the resistance area, and then the market sells off. So you could have caught a move here, could have caught another move here, right? Oftentimes, people are saying, well, I want the market to come off. What price action traders will do is they'll see this market come up, sell off. You put in this swing low here, rally back up. They're going to wait for the market to trade below this swing low and to say, yeah, what, this is resistance here. But if you're reading what's happening in the order flow, you see these points of control right here. You see the negative delta. You see this bearish prominent point of control. You've got 2 trades already. While the price action traders are waiting here at 31.13 for this breakdown to happen. So you could cut, a couple points here, another couple points here, while everyone is just sort of sitting around waiting to see what happens. This is what I talk about when I say, order flow gives you an edge over other traders, right? You're not just sitting around waiting and waiting. You're actively seeing what's happening in the market and basically trading the market. You are a trader. Now, when I explain how I trade to people, they always say, well, you're a counter trend trader. Well, I like to think of myself as more of a reversal based trader as opposed to necessarily a counter trend trader. And what that means is, when I think of reversals, I think, the trend is over and the market's going to reverse. It's going to go from, say, a demand-driven market to a supply-driven market and vice versa. Whereas when I think in terms of counter trend, what I'm looking at is basically a pullback, and then the market stops and goes in the same direction that was earlier. So like the market's going up, we hit a swing high, comes off a little bit, goes sideways, and then resumes the move back up. And this is where a lot of traders struggle in trying to trade a reversal, right? When you think of a reversal, right, they expect the market, well, at least me, I expect the market was moving in a one-sided trade in one direction, for example, up, to all of a sudden move in the opposite direction on one-sided trade, go back down. The reversals happen when, you have a demand-driven market turn into a supply-driven market, or a supply-driven market going down because everyone's offering supply, turns around and starts rallying on demand. But often what happens is the market reaches a level where, it got one-sided trade, it's all demand on the way up, then it reaches a level, it doesn't just turn around and sell off, right? What happens is you have two-sided trade. Market just rotates, goes sideways. The key is in determining if the reversal will happen or if the market has hit a level to rotate. Now, once you get out of that rotational period, then the market can go up or continue reverse and go down. So you got to be able to understand what's happening in the order flow, and it's going to help you determine what sort of what's happening in the market, what's going on that you can take the trade. So here, for example, market rallied up. Okay, you got nice buying. You got these nice green candles, nice positive deltas, 666. 192, 94, right on the high of the day. Okay, so aggressive buying on the way up. Market turns, so minus 95. So you got positive delta at the high, then the next bar off of it, negative delta. But the negative delta is, it's one trade higher, 94 versus minus 95. Then more aggressive selling coming in, minus 169. So potentially I'm already thinking, well, okay, just based off the delta alone, I'm thinking, what was a demand-driven market on the way up, which was kind of petering out, 666, then 12, which is nothing, then 192, then at the high only 94. So I'm already thinking, if I'm looking for this market to take out that high and go higher, I want to see stronger delta, right? Just as earlier when you took out the high, is very strong delta, 600, took out the high again, new high. Yeah, it's nice strong delta. It's not stronger than earlier, but okay. Even though the volume is slightly more. But then when you hit that high, it's only, the delta is contracted. It's less than half of what it was the prior bar. And then market starts coming off. You got negative delta, right? Then the next bar, stronger negative delta. Then, you start looking at what's happening inside the bar. You see, obviously, you got the thin prints inside. You got 3, you got 0. You've got 3 selling imbalances inside the bar. You've got lower points of control. Points of control since the high is lower, lower, lower. Points of control starting to migrate down. Then the market goes a little bit sideways. Small deltas, 511. This is what I'm talking about when, determining what's going on in the market, right? Market was going up, demand driven. Starts coming down. Looks like it's supply driven. Then it just goes sideways. This is an area where a lot of people, sort of get trapped in here. They're thinking, well, okay, well, we're starting to come down, and now we're starting to go back up, right? You got the green candle, green candle again. They're both the same lengths. Point of control is a little bit higher, but look at the delta, 5, 11, which is nothing, right? It's basically might as well be 0 for all intents and purposes, because that's kind of neutral. I always talk about having small deltas as being kind of neutral in the sense of analysis. The only bullish thing it's got going for it is the point of control is a little bit higher. That's it. So you just got to wait. I'm already leaning bearish, right? I'm already leaning that this market's going to sell off. And what do you get in the next bar? A nice strong negative delta, 183. So now I'm convinced, I should be convinced by now, that this market is going to sell off rather than rally. Then the next bar comes in minus 195. Like I said, when I talk about small deltas being neutral, 5 and 11, if you're just looking at what's happening in these deltas, minus 95, minus 169, overlook these two because they're neutral, minus 183, minus 295, it's getting stronger, right? And then, obviously you got the selling imbalances in this bar, got a couple in this bar, lower points of control. Finally, point of control slams down here below the low of all these other bars. So you got a lot of bearish things going on. You get the bearish setup here with the points of control in these two bars. Then you get this nice move down from, basically 1471 down, off the chart. Now, at a low, again, you try to understand what's happening in the market, right? Market's selling off, nothing dramatic, it's just grinding its way down. You got this string, mostly negative deltas in here. 42, minus 235, minus 66, minus 27, minus 141, minus 44, minus 299, minus 137, minus 228, and then minus 14, and then positive 127. So take into all the account that everything that's happening here. You got some strong selling, but as you're coming into the low, you get that last bar with the strong negative delta. Then it just starts to go sideways. The nothing delta, minus 14, which is neutral. Then you get this bar here, nice strong positive delta, 127, 4 buying imbalances in there. Then the next bar, again, kind of a neutral delta, minus 29. Next bar, minus 10. Maybe you're not convinced yet that, this is the low, that maybe we're shifting, right? Because, if this market was going to keep going lower, you're going to have a stronger negative delta here. You're going to have another stronger negative delta, not two that are kind of small and kind of neutral. And then it comes back here with a nice positive delta, 89, and again with 4 buying imbalances in there, right? So by now you should be convinced that, the direction of this market is back up. Then it just goes sideways a little bit before it gets another pop and moves, basically from 69.5, 69.60, all the way back up into the 71s. Now, so I sort of touched on a little bit earlier is, most traders don't know a reversal is underway until it's too late. But what I mean is, until it's too late is you've just given up, a few points in profit. Traders, they like to wait for confirmation. Chart traders, I need confirmation before I can take the trade. Well, sometimes you're waiting for confirmation. You're missing the juicy part of the trade, sort of in my opinion, the low-hanging fruit. They want to wait for higher highs or lower lows to appear. That's going to make your entry less than ideal. For example, this chart I was showing you earlier, right? Reading this in the order flow here, reading the points of control, reading the delta, you could have just had a nice little move here of a couple of points, pulls back to your entry. Could have got, if you didn't take that trade, even if you took that trade, you're taking some heat, comes back up here towards your entry, kicks off another bearish sign. If you weren't short already around the 15.5 area, you could have got short in here at around 15.5 again to catch that move down. But most traders, most price action traders, are going to wait for this low to be broken here at 31.13. Well, you just missed, getting short at 15.5 twice, right? Because you're waiting for confirmation. Oh, I need confirmation. I need confirmation. Well, you have your confirmation based on what the market is telling you right now. Here's another example. Price action traders are going to wait. Okay, well, yeah, we rallied up, came off, rallied back up, then boom, we break up here. They're going to be looking to get long somewhere around, this breakout here around 97.5, 98. But if you're reading the order flow, what's happening in the order flow, you got a lot of good information. Obviously, you got your ratio and divergence here. So you could be buying it somewhere around 93 down in here, 92 to 93. Okay, you rally up, you come off back down to the 92, 93 area. Then you see the buying again happening in here. You got 3 buying imbalances in this bar, 3 buying imbalances in this bar. Market goes sideways, comes off a little bit, still back to 92, 93. Market starts rallying back up here. You got this nice strong positive delta pack in here, and then it goes sideways, doesn't sell off. You're looking at some strong negative deltas here, minus 524, minus 668. You're probably thinking, you know, you know, if I was long in here, I'm thinking, oh boy, what's going on? But the thing to keep in mind, right, is you're still in the money. You're still trading a little bit higher. Now you got the aggressive selling, right? What's happening? You hear this term a lot, you know, are traders getting paid? Okay, so what's happened? You got some strong selling in here. Look at this, 1200 negative delta, 500 negative delta, 600 negative delta, 367 negative delta, 734 negative delta, 524 negative delta, 668 negative delta. But what's the key takeaway here? Even though you got some strong selling, why isn't this market selling off? Right? Every time it comes off, the buying reappears. The selling basically stops. Right? You get the you know, traders coming in here, I gotta sell some more, but they can't push it any lower. Again, they try it again here, can't push it any lower, buying comes in. Trying to push it lower, can't push it any lower. Now you're even at a higher level, sort of a higher lower level, right? In here it was happening around 96, 95. Then you're coming in here around 95, 94. Now again, back up to 96, 95, and it can't move it any lower, right? You got sellers coming in here. Oh, I want to push this market down. I want to get paid, right? I want to sell it and buy it. You know, I'll sell it at 95, buy it at 91. You can't even get below 93 before the buyers step in and start buying it back up to the 95 area again. So that's the key takeaway. All right. I mean, you should already be thinking of getting long off of this low, off this ratio and divergence down here. You know, that's your sign. Obviously, down here, you're hanging at the bottom of, you know, the day, the low of the day, and you got nice, strong, positive deltas in here. You know, that's very bullish. Market goes up, some selling comes in. These sellers aren't getting paid. Market turns around, they try it again. They're still not getting paid. They tried a third time, still not getting paid. You know, if you sell the market 3 times and you're not getting paid, chances are, you know, you shouldn't still be in that trade, right? You're gonna think, gosh, you know what? Why am I selling it? You know, you're gonna cover it, and that's why you see as you break out through this high area, the aggressive buying coming in. Now we're trading 97. You know, all these guys that are short at 96, 95, 95, 94, 96, 95. All of a sudden they got to buy it. You know, we're starting to trade 97. You know, what the heck? Why am I still going to be in this trade? I tried selling it. I had 3 opportunities for the market to break and it couldn't. They don't want to be short anymore. That's why you see the aggressive buying coming in, and it happens very fast. It gets through these levels with very little volume on the counter trade. You know, 4, 3, 71, 0, and it just finds this new level up at 99, where you get some decent volume going through. So all these guys that were selling it here that weren't getting paid, you know, they got to cover it basically. But you could see it in here. That's why, you know, you got to watch what's happening and understand it in terms of, are traders getting paid as the market is selling off? If they're not, what do you think the market's going to do? It's not going to go lower anymore, right? The sellers are gone. They're not interested in selling those lows anymore. Now, again, my honey hole, right? The topic of this module is finding your honey hole. I find my honey hole is reversals, right? And where's the reversal going to happen? The highest potential profit on a reversal is going to be at your high of the day, your low of the day. Every new high becomes a potential top, you know, because with the top comes a potential reversal. But what often happens around a top, you know, profit taking. And when you're getting up to the highs, you got to be able to figure out, well, what kind of high is this being made? You know, is it FOMO buying, or is it, you know, real legitimate long-term traders, real money that is buying this move up, right? Because if it's FOMO buying, you know, if it's, you know, taxi drivers and bakers and butchers that are coming in and buying the markets, or the last people coming in to buy the market, then, you know, it's got a nice possible potential for a reversal. And the same is true at a low. You know, a new low has the potential to become, you know, a reversal. You know, it can be your bottom, could be your low for the day. Now, the other thing to keep in mind, traders generally do not reverse their position at a reversal level immediately. And what I mean by that is, they rarely immediately go from long to short at once. They go long, let it ride, take profits, wait for a sign to go short, and vice versa. They get short, cover their shorts, wait, and then they get long. That's why you see markets hit a high and go sideways. Markets hit a low, go sideways before making that run. And of course, there are times when market shoots up, hits a high, immediately turns around and shoots back down. Or, the reverse is true for when you hit a low. You got that nice V shape. The market comes down at a 45-degree angle, rallies back up at a 45-degree angle. But more often than not, you hit a high, market goes sideways. As traders are determining, is this high going to hold and are we going to reverse, or is this high just sort of a waiting area before we take out the highs and make new highs? Same thing with the low. So for example, here, this is the S&Ps. That's why I talk about, trying to understand how is the high being made. Is it being made with solid institutional real money buying, or is it being made with, sort of a euphoric buying coming in? And for me, one of the ways I determine that is I'm watching what's happening. Obviously, the deltas, you're making new highs. You want them be nice and strong and positive. You have that. That's a given. But what I'm looking for are areas, the volume in the bar. When I see making new highs and I see it trailing up to new highs with selling imbalances, people think, well, selling imbalance, the first inclination is to think, well, shouldn't the market come off? Well, if you have selling imbalances on bars that are closing higher, the green candles, it's telling you there's support in that market. Right? So you see it in 1, 2, 3, 4, 5 consecutive bars, then another few bars here. What's happening? You see these imbalances, you think, 299, that's nothing. But if you're looking underneath it, you see some strong bids coming in. 2,900, 1,100, 1,900. Here's 1,700 on this imbalance, 2,900, a couple thousand. Here you're seeing 2,200, 2,200. So if this market is going up and I see strong bidding coming into the market, usually the first sign is going to be these selling imbalances. Then I know that this move has, real money behind it, as opposed to just a bunch of buying imbalances on the way up, just aggressive buying. Because, when the market is moving higher, you tend to see a lot of aggressive trading coming in. But when you see a lot of passive bidding coming in to support that market, the market's got, some strength behind that move. Now, I want to take you through this. This is about almost a 1 hour period on this day. This is a 1 minute chart. So we hit our low of the day. Okay. Like I said, markets don't often just come right down and reverse and go right back up. What happens is they hit the low, sort of go sideways, right? We hit the low, start rallying back up a little bit. Then you got nice, positive, aggressive buying coming in here. Nice strong delta, 1,800. Okay, but more importantly, look at the volume, 6,451. So you're seeing the volume pick up dramatically right off this low. So I know in here, I'm seeing, other traders, other long-term traders potentially coming into the market. Because, if we're just looking at sort of, your average volume numbers coming in here, 1,500, 2,000, that's, sort of your average numbers. But when you're seeing it sort of swell up, 3,900, 4,500, 6,500, 4,000, I know that there's new buyers coming into the market, in the sense of, I don't say new buyers, but new traders coming into the market because they think this market is a good deal, right? It's a low price. Market rallies up, sort of hits this high area. You can see the buying sort of goes back to normal. 2,900, 2,300, 3,000, 1,900, 3,000, 3,900. Now we just went from, where we were trading earlier, where this big volume spike was, 31.13.5. Now about 15 minutes later, we're trading 18.5, so we're about 5 points higher. Okay, so if you're an institutional trader, if you're a big trader, you want to be long, right? You're looking to get long in here earlier. but now the market's moved, right? It's moved, you know, 4 handles, 3.5 handles, 4 handles, almost 5 handles. Okay, well, that's not good. You let the market breathe. You let it come off, right? You can see the volumes, very small volumes, 1100, 1700, 1600, 1200, 1600, 1600, 1700, 1400, 1200. Okay, so the market's just moved 5 points. Now, what they have to do is they have to let it relax. They got to let it breathe a bit. So at this point, okay, people are starting to think, you know, is this move over, right? Or not, right? Like I said, you know, you're looking at your low, market rallies up. Okay, well, now is this move over? Because you know what? There's no more buying coming in here. Oh, we don't know yet, right? You got to wait. Wait for what happens. Market starts coming off. This is that area. Then you get down in here. Boom, the buying reappears. Positive, big positive delta, 2,700. Volume, look at that, off the charts, 9,000. Next bar, 7,000. As you're trading inside. Okay, so you got your big bar up. Boom, some very strong buying. Market, you know, it came off from 18.5 back down to 15.5. Buyers, you know, longer term money still see this as cheap, right? We're just off our low. They buy again in this next bar. Okay, well, now we're back up to the 18.5 area. Well, you just saw earlier, right? Market went up from the 13.5 area up to the 18.5 area. They let it breathe a while. Well, what do you think is going to happen next? We're back up to the 18.5 area. Chances are you got to watch. Let's see if it's going to breathe again. Okay, starts coming back down. Gets back down to that 15.5, 16.5 area in here. Buying steps back up again. 6,000 in the volume. Right? Okay, at this point you should be thinking, well, now this is what I call a counter trend trade, right? You have your reversal here, starting here, right? Market went up. This is the counter trend here. Comes back down, comes back down, comes back up again. Let it breathe. Now this is your buying opportunity. You see that big volume come in, right? After you're just dropping from, you know, the 18.5 back down to 15.5, 16. Aggressive buying comes in. You know, this is what I would consider a low risk trade, right? You can be getting long at 17, but where? I'll move back up above 19. So, you know, you're looking at potential 2.5 points, you know, maybe even higher if more buying comes in later, right? And here you see a nice big burst of volume, 5,000. You know, if you're going to see what was happening here with the volume at 16, if you get back up here, market doesn't really come off. If you're going to see another burst of buying, where's it going to come in? It's going to come in around 19, right? And you can see it came in here around the 19.5 area. And if you get another burst of buying, next thing you know, you're going to be trading, you know, off this chart here. You're going to be trading around 22, 23. So you're getting long here at 17. Where's your risk? Well, it's below these areas where you have the strong buying coming in. Your risk is, you know, down here at 15.5, where the buying appeared the first time. So when a market makes a new high and there's no follow through order flow, the potential for reversal is high, you know, just as at a low. If there's no follow through at the low, you know, aggressive selling coming in to take out the lows, well, chances are the low is going to hold. So institutional selling at a top, right? This is the difference with tops. I think it's more noticeable in tops than at bottoms. Is it's what's hidden in the euphoria of public buying is institutional traders have the opportunity to sell a lot when you're making new highs, because, you know, everybody loves to buy, because when you're buying, you think the market's going higher, right? When people think in terms of selling, they're thinking in terms of just getting out. Most people don't necessarily equate going long and getting short as the exact same thing. But as the market's making new highs, you know, institutional traders, they love it. They're able to get out the move size without necessarily moving the market too much, right? So the thing to watch when you're going into new highs is the volume, right? Volume, you watch the delta, because there's I'm going to show you a couple examples, right? There's what I call high volume sell-offs and high volume rallies. High volume sell-off would occur at a high. High volume rally would occur at a low. And what happens is you hit a high, and then the next bar closes down, or the high bar closes down. You get negative delta, and more importantly, the volume is near the heaviest within the last X periods. I'm not saying it's got to be the heaviest for the day, because you could have a bar that happened around the open, cash open, 3 hours ago or whenever. It's got more volume. Really, what you're looking for is in relative terms, what's been happening now. How is this volume compared to the volume just previously? Usually the prior bar, when I say the prior bar, I mean the bar before the high was made, or the bar where the high was made, has got the heaviest volume. And for a rally, it's basically the same thing in the opposite sense, right? You're going to have a low, and then the bar closes up, positive delta. Volume is going to be near the heaviest over the last X periods. And usually the prior bar is going to have the heaviest volume. And what's happening is strong buyers or sellers are getting into the market and stopping the move. They're erasing the breakout. So for example, here, right, you get that big push up, and then you get your high right here. Yeah, you broke out, you made it high by 2 ticks, and then it gets slammed back down. What do you have going on in here? You got the negative delta. The volume is still relatively high. It's not the highest. The bar that you broke out is the highest. And these volumes here are highest than anything to the immediate left. Prior, you're looking at, your heaviest volume was, 2,400. All of a sudden you doubled it up, 5,400. Then the bar where you make the new high, still strong, 4,000. Delta is strong, negative. You got some selling imbalances in there. You got a bearish point of control. So you're not expecting this market to keep going up. Right now, the immediate trade is to go down, right? And it sells off nicely, a quick 20 cents over the next 10 minutes. At the low of the day, it's sort of the opposite, right? You break out here, nice strong volume, 21,820. People are going to say, well, over here you got a volume of 24,000. Yeah, okay. 21,000 is still stronger than what's happening immediately before it. 8,900, 13,000, 8,000, 10,000, 13,000. Even here, other than this bar right here, 17,000, 8,000. So it's still strong, right? It's still, the highest over the last 1, 2, 3, 4, 5 bars. Then the next bar, it reverses, right? It's a green bar, up bar. You got buying imbalances. You got nice positive delta. The only thing that doesn't happen in this bar is you don't have the bullish ratio. If that was a bullish ratio, I'd be like, forget it. That's just buy it, close my eyes, buy it, and write it for what it's worth. But all the other factors are there, right? So this is a nice place to be buying at the low of the day. And people say, well, you're always trying to pick highs and lows. No, I'm not. When the market gets to the low and gives me a sign to buy it, I buy it. Period. Okay, now I'm not trying to come in here when the market's trading 31.09 and predict, oh, we're going to trade down to 98, so I'm going to throw a bid in there and buy it. No, I'm willing to let the market do what it's going to do, sell off. It sells off to this area down here. Okay, now I got signs to buy in here. And you get long, the O area, the 01 area, makes the move back up over the next hour, back all the way up to 07. Now think of it this way, right? A small breakout on heavy volume. Well, there's a big effort being made without any reward. Someone is absorbing the selling around the high, but the market's not moving any higher. At a low, the opposite is happening, right? People are selling it, but someone's buying it, right? It's people that are people getting paid. Again, it's a basic term, but you should always be asking that. Are traders getting paid? Are these? We just made a new high, so all these people that bought the high in anticipation. Why do you buy a high? You think the market's going higher, right? If how to put it in everyday terms, right? If you say you collect baseball cards, right, and there's a card for a player that you like, and you think the market's going higher, well, you go to the baseball card show, you see the card is priced at $10, but you think, oh, by the end of the season, after he hits 70 home runs, it's going to be a lot more. You buy it. You buy the high because you think that the market for that card is going to go higher. That's why you buy at the high. So when it doesn't, it just goes sideways, say the guy breaks his leg, breaks his arm, okay, and you try to sell it at close to the price you bought it for. But watch for small breakouts on heavy volume. Okay, for example, breakout, we got this bar down here. It's a small breakout by 2 ticks. Got some nice heavy volume as you're breaking out. 24,000 new low, 26,000 new low, 19,000. Still decent volume, 19,000. But again, the previous bar had the highest volume. Then it starts turning around. It's a small breakout on heavy volume. But now the buyers are coming in, right? These people that are selling it right now as we're breaking out here to these new lows, 31, 13, 31, 13 and a quarter, 13 and a half. Are they getting paid now that we're trading 14? Are they getting paid as the market starts ticking back up to 15, 16? No. Now they got to start thinking of covering it. That's why you see the buying imbalance coming in here. You see the nice positive delta now. And then the market goes up from 17 all the way up into the 20s. Right? The small breakouts can give you some nice big trades. To the upside. Here's your small breakout. Here you make the new high, then it just goes sideways. You pair up the high, and then you break out by a tick. But as you pair up the high and go sideways, you got negative delta. You got selling coming in. You make a new high by a tick, selling comes in again, minus 138. Previous bars minus 124. The bar that you made the high had the nice delta, 2,500. The next bar, still nice positive delta, 1,100. Volume. Then the bar with the new high by a tick, fairly decent volume, 770. And it just starts going sideways before, falling over. But again, what's the sign that this market could be potentially falling over? Well, what do you see in the deltas, right? The negative deltas. What do you see in terms of imbalance? What do you see in terms of points of control? So, volume shows us what's happening in the market and can create areas of supply and demand. Price is the value of volume. Now, again, the whole topic of this module is finding your honey hole, right? I just explained my honey hole is reversals, right? And it could be swing highs, swing lows, highs of the day, lows of the days. For others, it could be, a small pullback in a trending market. Now, most traders are familiar with Japanese candlesticks, right? And there's a lot of traders out there that just trade simple candlestick patterns, right? With nothing else. They just looking for patterns. And whenever the market leaves a particular pattern, they just buy and sell. Basically a red light, green light system. But if you've ever studied candlesticks, done your own analysis, you'll know that even like the best of the best setups in candlestick patterns aren't 100%. Like the best ones, maybe run into the 60%. And that's just winning percentage, win-loss. Not even talking, length of move, like how far is move. Maybe it's 60% with, a small winning amount. But, it's one of those things, is it going to be red or black, basically, like a roulette wheel. It's a 50-50 chance. But, when a candlestick pattern you see people say, well, this one's got a 60% chance of being a winner. Well, they don't always tell you, the actual risk to reward ratio part. But when a candlestick pattern has interesting order flow in it, say it's a bullish pattern on a candlestick, but you got bullish order flow coming in, it becomes even stronger and it attracts the attention of order flow traders. Because not only do you just have a candlestick pattern and all the candlestick guys are getting excited, but now you got order flow traders also being excited. So keep that in mind, right? it's important to remember that there are thousands. There's more candlestick traders than order flow traders out there, but unfortunately, the candlestick traders got, in my opinion, a lot smaller amounts. I've never met a big, well-heeled, well-financed candlestick trader, but I've met well-heeled, high-financed order flow traders. Or people that trade order flow got more money behind it. So when I see, order flow traders coming into the market based on what's happening in the order flow, I think it's going to give you a stronger move than a pure candlestick pattern. And you don't believe me, you think I'm just talking smack, you look at the all these algo firms, right? They're trading order flow, they're not trading candlestick patterns. But anyway, perfect example. All right, here you got your swing low, you got a nice bullish candlestick pattern right here, almost this engulfing pattern. And what's happening in the engulfing pattern? You see nice stacked buying imbalances. You're coming in with 1, 2, 3, 4, 5, 6, 7 imbalances, 8, 9 in this bar. It's an engulfing pattern, right? I mean, people always like to show these candlestick patterns. Oh, here's an engulfing pattern, but they only show the times that they make money. They don't necessarily show the times that they lose money. And you understand, right, if you've done any form of candlestick analysis, that not all candlestick patterns work all the time. Like what I'm trying to say is, when you can add something to it, that is going to justify taking that trade, you can take the trade. I know I got aggressive buying coming in here, right? I got the positive delta. I got the zero prints inside the bar. To me, this is a nice bullish pattern, right? And candlestick, I got to get long right now. Well, I know that I've got this area in here where I'm looking for a retracement back. Point of control's up here. I know I've got this area potentially to buy on a pullback. So I've got areas I could also enter the trade in here. I could get long immediately, or I could get long on a pullback. I could expect a pullback to this area of the aggressive buying from earlier. Doesn't quite get there, but it gets into this area below the point of control. Gets into the area just slightly above the imbalances. I mean, later on it came back down to the imbalance area before going back up. So, when you combine things like candlestick patterns with order flow, that could be your honey hole. There are a few candlestick patterns that I like. I love shooting stars. I love hammers. Obviously engulfing patterns, but engulfing patterns I think are quite obvious to everybody. So you got to find your honey hole. Find your method of trading that is going to give you an edge over other traders. For me, I've found that trading reversals, finding reversals when they're happening, is my honey hole, right? It's going to give me the high percentage trade with a good return. So this ends module 2. In module 3, I'm going to discuss trading the cash open, and it's important to understand what happens on the cash open, and that shapes the trading day more often than not. So I'll see you on module number 3.